Okay, let me quickly go into the business of the day. Today I'll be taking us through how to analyze a chart like a professional. You see, you don't need to make things sound so funny for it to be understandable. Um, Trading is not confusing. Trading is not gambling, and trading is not something you do anyhow. Trading is something you do with a probabilistic approach in mind, but always having your edge in heart. Yeah. So basically, if you watch my chart, and if I anytime I put up my chart, one thing you're going to take notice of is that they are all properly charted. So I just take note of what I want and what I don't want, and I wait for the market to come to me. I don't run after the markets. So basically, I'll be taking us through some basic steps I take personally when I'm trying to analyze my chart. And believe me, it's one of the best professional approach. So firstly, let me start. The first thing I mark out in my chart is area of supply and demand. An area of supply and demand is just like a psychological level. Let me put it this way: is a level where the market suddenly bought or suddenly sold. So a place where the market suddenly bought so greatly after accumulating so many order is a demand zone. You take a look at this one now. Take a look at let me show you these demands. Okay, this is a demand zone on the 4 hours, and this is a supply zone on the 4 hours. So this is where the market sold from massively. If you watch here, the market sold massively from here. So I'm going to stretch this out. This is a supply zone. I should, by default, know that when the market gets here again, 75% of the time, 80% chance that is going to sell off. If not this very um, level of volume of pips, it should sell off to some degree. So I should be expecting this reaction when the market steps into this zone again. Now, an area of demand is a place. Let me move this to the daily so you get what I'm. An area of demand is a place where the market bought from previously. It's a form of massive buying. So mentally, people are going to take note that in the market gets to such an area again, they should be expecting such a move. So an area of supply and demand is something that is more of a mental note people make. It takes a huge sum of money to move the market by a pip. So imagine where the market moves by 10, 20, tens of pips, hundred of pips. The traders just take note of those levels, knowing fully well that something like that may occur if the market revisits those zones. And a demand zone or level is not just a point or a price point, is an accumulation of several price points, like a 5 to 10 pip range. It's just a 5 to 10 pip range. Well, I'll teach us, or I will take us through all those things gradually, time over time and time over time again. So after marking out my area of supply and demand, the next thing I will go for is my levels of interest. Yeah, my levels of interest now. If you watch, if you watch now, these are like my levels of interest. Let me show you these now. Let me move this to the 1 hour. When the market came along here, it fell off, and there was actually a break in structure here. I took note of this very other block here, and this roughly 9 pips to gain 46 pip, and it was actually smashed. As simple as that. So next thing, after marking out my area of supply and demand, I'll take a look at my levels of interest under those area of supply and demand, owing to what's in play with the big picture. Okay. After that, the next thing I have to understand is the market structure. What do I mean by market structure? When I go to the higher time frame, who is in control? The bulls or the bears? Are we buying? Are we selling? You see, there are lots of things you put together just to make it happen as easy as it is. Now, look at, let me show something here now. After, okay, let me move this to the 4 hours. This dollar index. After the massive buy in here, I marked this place to be a valid 4 hours demand zone. And we sold into that demand area. That's where a massive buying occurred. And without any form of contradiction, risking 30 pips to gain 121 pips, the market played out that way. Actually, I left this other block here, but the market still it flew. So that's still fine. So the first thing, as I said earlier, after marking your area of supply and demand, you take note of your levels of interest. I was interested in this zone, that's why I marked it out. The next place I was equally interested was this very other block. Now, if you watch, though I did not continue the trade, the market came, went above the other block, retested it. This is a valid flip zone. This retest made it a valid flip zone, and then continued. Though we've left by then. Now you take note of what happened here now again. This is an area of a massive selling again. What did I do again? I just marked out that area. I extended it to the future. And I put up a trend line liquidity to see what's going to happen, to help me see how price is being controlled as it travel up to this very zone. So when you've done that, the next thing you have to take a look at is, after understanding your market structure, who is in control, is it the buyers or the sellers that are in charge of the market as it stands now? The next step you have to do is, what's the higher time frame doing? What do I mean by that? You go to something like the 4 hours or the daily, and you ask yourself, what's the higher time frame doing? What's the market structure there like? The bulls or the bears, who is in charge? The buyers or the sellers, who is running the market as it stands now? Because one thing you can't do with the market is, you dare to trade against the trend. Believe me, it can be deadly at times. Yeah, trying to trade against the trend can be deadly at times. So you don't trade against the trend. Then after that, another thing you have to do is you take note of your levels of interest on a lower time frame. Now, if your entry time frame is something like the 1 hour, the 15 minutes, the 30 minutes, the maybe the 5 minutes, just take note of what is going on those levels. So you mark out levels of interest on your trading or trade time frame. Then when you have done that, the next thing you have to do is where is the unmitigated order block in my time frame? So when you have done that, you ask yourself, where is the unmitigated order block in my entry time frame? Yeah. When you have done that, the next thing you have to do likewise is to determine how much you are willing to risk. How much you are willing to risk. Yes. You determine how much you are willing to risk. Then when you have done that, you keep your mind in check. Let the trade run. You see, trading is a mental performance. Is a psychological game, and a risk management, whatsoever you want to call it. Because everything boils down to risk management and how you permit your psychology to pull you through what you are doing. If your risk management is a mess, and if your psychology is should I say, actually wrong about what you are supposed to be doing, what you are supposed not to be doing, what you should be expecting and what you should be expecting, believe me, you're gonna feel frustrated, because 95% of the time you feel as though that the market is after you. You feel as though the market is there to frustrate you. The truth is that the market doesn't know you. The market does not recognize you. The market in itself is an outstanding reality. It does what it wants to do when it wants to do it, and however it wants to get it done. So the market does not even have you in heart. So why am I sounding like this? I'm sounding like this to let you know that there are so many participants in this market. But if you see yourself using this very approach time and time again, you will notice something. Your chart will be neat. You can't see any indicator on my chart. I don't put up indicators, not because I don't believe in them, but I believe in naked price action. If I should be able to read price action naturally, I should be able to tell what's happening in the market. Indicators are wonderful, but for me, I believe that they bring you to the party late. They are derivatives of past price action. They are dependent on market price action to react or to move or change levels. So they don't naturally give you they are not current. If you want to be current looking at what the price is doing, you should learn to trade with pure price action. And when you are trading with pure price action, you notice something. You just feel within you without being told that you have actually leveled up your game. And there's this kind of simplicity in heart when you just look at my chart now. You see how neat it is. I've marked out what I want and what I don't want. So I'm actually waiting for price to touch those levels. Yeah, sometimes when price get to certain levels that I'm interested in, maybe as a result of a raid or a fake out, I might be stopped out. But if my bias was actually wrong, and on my entry time frame, I see markets not just putting up a reversal, but I saw that what happened was just a fake out or a raid of a level. I re-enter, and when I re-enter, I pull back my risk and I still join the predicted or the expected move. As simple as that. Don't get it complicated. What I've mentioned so far on what I told you on how to analyze a chart like a professional. Firstly, mark out your area of supply and demand. After that, you look for your levels of interest. You understand market structure, know who's in control, the bulls or the bear. What's the higher time frame doing? What's the market structure on the higher time frame? Who is in charge on the 4 hour and the daily? Mark out levels of interest in your trading time frame or your entry time frame. Where is the unmitigated order block on your entry time frame? Determine how much you are willing to risk. Keep your mind in check. Let the trade run. Forget about it. Get something else doing. You have to learn how to manage your trade likewise. Know when to move your stop loss to break even and let the trade run risk-free. And actually, I'm going to dwell more on that when I begin to touch on time frame analysis, because some people don't actually know how to move their stop loss. That's why 50% of the time they make a mess of themselves. And that's when you should see people saying things like, it's like the market is out to get me. The moment I click buy, that's when the market starts acting all the possible drama. That's still fine. I'll be doing justice to flip zone when next, because these are simple basic concepts. I tell people, keep the market simple. Stop getting it complicated with so many whatsoever. Just keep it simple as much as you can. So this is all I have to say. Just believe in yourself. You can do it. In the long run, just keep on keeping on. Everything will appear simpler, and you see, though you don't control the market, but you react to what you see.